enthusiasts. Welcome to our highly anticipated webinar. Are you looking for risk and regulatory clarity of offer crypto custody? It is my utmost pleasure to be your moderator for this insightful and engaging session. Today, we have gathered here to explore the intricacies of risk management of crypto custody, a topic of utmost importance in the ever-evolving world of cryptocurrencies. We are privileged to have an esteemed expert, Alexander Casting, Vice President of ISACA Luxembourg, join us today. With his extensive experience in advising on business opportunities and his deep understanding of crypto technology, Alexander will share his wealth of knowledge and shed light on the risk and regulatory aspects of crypto custody. Throughout this webinar, our aim is to provide you with valuable insights, practical strategies, and thought-provoking discussions that will empower you to navigate the complexities of managing risks in crypto custody. Whether you are a seasoned professional, an aspiring learner, or simply someone with a keen interest in this domain, this webinar promises to offer you a wealth of information and inspiration. As we embark on this intellectual journey together, I encourage you to actively participate, ask questions, and engage in discussions with Alexander. The exchange of ideas and perspectives will undoubtedly enrich our collective understanding and pave the way for innovative solutions to the challenges we face. So you can share your questions related to the topic in the chat area. After Alexander's presentation, I will direct the questions to him. Additionally, I would like to remind you that the event is being recorded and we will be sharing the recording on our YouTube channel. And now we are honored to have Joris Werdeling, the European chapter advocate of ISACA, delivering the opening speech at our event. Joris will share ISACA's expertise on emerging technologies like blockchain. Now, I would like to invite Joris Werdeling to the virtual stage to deliver his opening speech. Joris, the floor is yours.
Thank you so much, Jürgen. Thank you a lot for inviting ISACA Global or ISACA Europe to open this webinar that we kind of set up together, connecting different chapter leaders throughout Europe, which is well one of the tasks that one of the nice things that we do at ISACA Global. Welcome to all attendees, of course. Happy to be able to speak to you as well today, even if it's virtual. We were discussing this afternoon about the possible visit sometime soon, hopefully to your wonderful country, wonderful city. So also working, of course, with the Ankara chapter. So I'm really looking forward to having the opportunity to see you in person and to actually meet with the local community in Istanbul, which is a vibrant community. I want to take the opportunity to congratulate both yourself, Yukan, and Hayi Can, who's behind the scenes running the technical part of the webinar for your great work as volunteers for your chapter. Currently, let me first position the terminology of ISACA Europe. Maybe for many attendees, it's not quite clear. Of course, ISACA has a headquarters in Chicago. A couple of years ago, the decision was, let's say, ISACA realized that not everything could be done from Chicago, especially with growing regions, specifically in Europe, which is one of the bigger regions for ISACA after North America. And the decision was made to create local teams, regional teams, to support our chapters and to actually boost ISACA, our credentials and the value of membership, etc., on a more local level. And that is where we, as a European team, come in. We have grown within a year to 10 members, and well, we have a leader of the team who is also the global strategy officer of ISACA, who is working from Greece. We have 3 people based in Madrid, like myself, in Spain. There's a business development director working from London. So the team is fast growing and also expanding after we opened our first office in Dublin in September last year. And that is why we are what we are currently focusing on. So in my particular role as a chapter advocate, working closely with you as chapter leaders, which is a pleasure to support you, to organize this kind of great events and also other initiatives. As I mentioned before, I was going to mention Currently, ISACA has rolled out a pledge where we are offering free membership to students in related areas within the IT and IS study fields. So anybody who is studying at local universities in Istanbul, Ankara, or throughout Turkey is very much invited to join ISACA, to join a local chapter and become part of the community. And again, I'd like to take the opportunity to congratulate the Istanbul chapter for the sky-high numbers that you are achieving within this pilot. You are by far the most successful chapter in capturing the attention of students. Almost 1/5 of all the students that we have welcomed so far within this pilot in the last 6 months. 1/5 of them for whole Europe are in Istanbul chapter. So the chapter is really growing as a young community, young country. We know you are. So this is great news that confirms that you are doing a great job as chapter leaders. And again, I wanted to take the opportunity to really congratulate you on that again. And then, as I mentioned before, you introduced Alex briefly, of course, currently vice president of the Luxembourg chapter. We know each other for a longer time because he used to be the president before he went to the vice president role recently. So one of the things we are also doing as a European team is to really build the European community, to make every chapter feel and every member feel as they are part of a European community of ISACA members, leveraging all these opportunities, the networking opportunities, the knowledge sharing, so that it's no longer just from ISACA Global communicating to members and to chapter leaders, but really making ISACA visible on a European-wide level. Of course, we have because of regulations and all the stuff that you will be talking about, I'm sure, and know a lot more about than I do. We have the European Union, which is within Europe a strong internal market and region that is one of our main focus areas. But definitely, Europe as a whole is a region for us that is a huge priority. We're opening chapters in countries where we haven't got any chapters. In a neighboring country, actually, to you in Georgia. I'm talking to future chapter leaders in Tbilisi. Many chapters in many countries and cities in Europe. We already have chapters, but we definitely have some way to go. So that's just to situate. As I see that in my name, I have the ISACA Europe term for you to understand that, and hopefully we will see more from you as chapters, and you will see more from us from the ISACA Global, ISACA Europe perspective. And then just briefly, of course, you mentioned ISACA has many resources when it comes to emerging technologies, when it comes to blockchain, AI, IoT, not only resources, but even certificates and certifications. One of the newest certifications is CET, it's the Certified in Emerging Technology, which is made up of four certificates on AI, on blockchain, on cloud computing, and those certificates can be earned individually. And when somebody decides to take all of them, then they can apply to become certified in CET, and then it would function like the certifications of ISACA that many of you probably know with the CPE registration and the annual renewal. So I will put some links in the chat because I thought that would be more helpful maybe than to share my screen and give a presentation about it. I will put some useful links in the chat. And with that, I will definitely hand the floor to Alex, who is a real expert here today, and will teach you hopefully a lot of new things. If anybody has any questions quickly about this brief presentation or wants to know more about ISACA Europe, I definitely invite you to connect to myself on LinkedIn. I know I have a difficult name. Your names are difficult for me, but the other way around is the same. So I'll put my LinkedIn profile in the chat as well, in case anybody wants to connect. And nothing further from me. Just wishing you a great webinar, and thanks again for all the efforts.
Thank you, Joris, for the information you've shared. Alex?
Okay, so I guess it's time to share my screen.
Yes.
Let me do that. Hi, everybody. So I'm gonna use this presentation. Let me just make it, maximize it. Where is it? Should I have the screen here? Where's that? I can't see the, oh yeah, here you are. Oops, no. That's the one I was looking for. Okay, can you guys see that? That's good. All right, so so I guess today we're here to shed some light on risk and regulation related to crypto asset custody. The reason why we use crypto asset custody is because it's becoming more and more of a concern, and we thought it was probably a good idea to tell a little bit more about that specific topic. So I have four parts to the presentation. So I will start with a little bit about the crypto market, so giving you insight about what the crypto market looks like. We go through basic terms just to make sure that we understand each other. Then we'll jump to the risk. We'll use a framework we use in our company. Then we have a deep dive on some cases that happen. A deep dive on crypto custody to understand what it entails and what are the specific aspects that needs to be considered. And then we end with some of the concrete examples of issue that happen, so that I hopefully give you some insight of why it's so important to consider all those aspects. So with no further ado, I will move on to the first section. So just making sure we understand each other. So the first thing I wanted to bring up is cryptocurrency, or coin is a term I will use throughout the presentation. That's basically a piece of code that is being held with a pair of cryptographic keys. So that's what it means. Then we have the wallet. The wallet is, you can think about it like your banking app. That would be more or less the same. So you have different accounts with different currency, and then that's the way it works. It could be online, offline, paper-based. So you have different ways of getting a wallet. Then you have how you exchange the crypto. You go through a crypto exchange, like a regular securities or commodities. So you go on those exchanges, and then you can swap it. There is also what we call the DeFi, which is basically not exchange related. So it's more a smart contract that will allow you to swap your crypto with another participant, basically. Then another aspect that's important to understand is what makes crypto a blockchain, crypto complex, is because it uses a blockchain, and blockchain is cross-jurisdiction. So it makes the regulatory endeavor quite complex, and we will see that in a minute. The last thing I wanted to bring up is obviously on the blockchain is the infrastructure. Then on top of it, you can basically create application, write smart contract, add specific features. So you have different layers on top that is more at the application level. For those who are very tech savvy, you can think of it like the Aussie model. So you would have the basic, lower, layers, and then as you move up, then you have more complexity and more feature added on top. That's basically the way it works. So if we look at the market, so the entire market basically blew up in 2022 or 2021, sorry. So where we had that huge spike where crypto went up, and we went up to 3 trillion. So 3 trillion is obviously getting noticed from a regulatory standpoint, because they see, oh, that's getting bigger. It's not a bunch of nerds in the basement now. It's people are really getting engaged. Obviously, we had a drop with number of circumstances. I mean, an event. I will touch on a few of those that basically dropped the whole market capitalization to 1 trillion now. And it's coming back up, and we are expecting this to rally again in October up to March, April, when we will have the next halving event for Bitcoin. That's basically every 4 years, a Bitcoin basically divides its value by the number of Bitcoin created are divided by 2, and that's why you have usually a rally during at the end of that cycle. So if you look at the past 9 months, it was quite hectic, like a bit of a roller coaster, I would say. Like you had huge negative event that basically affected the price. It started all with the FTX situation, so we'll touch a little bit more on that later. Basically, FTX was a stock exchange that went down just because it got involved in criminal activities, and I will explain why. And then you had beginning of this year, we had number of issues with a US bank that went under. And you can see, like, you had the Civil Bank, you had a Signature Bank, you had I forgot this one. You had also the other one in the Republic Bank, First Republic Bank, sorry. So quite a few banks went under just because of the mortgage rates. That what was drive the loss. It wasn't related to the crypto market per se, but some people think that there was something happening behind the scene. And basically, one of the things that basically came up in some of the conversation with crypto experts is that people drew a parallel between that situation that happened in US and what happened before with the gambling industry. So it was called the Operation Choke Point 1, the one that happened in 2017. And you can see that, like, a lot of people are speculating that what happened in the US beginning of this year was basically Operation Choke Point 2, where the regulators and US institutions tried to shut down the entire crypto market. It didn't succeed, luckily for us, but at least they tried. Then obviously you had quite of a lot. You had a bullish signal in April, where European Union approved the MiCA regulation, and that regulation basically set some clarity about how to approach crypto asset. So that was a very good move from the European Union to do that. It's not a great regulation, but at least that's a start. Then you had Hong Kong that basically also opened the door to rating retail sales. So basically now retailers clients in Hong Kong are able to access the crypto market. It wasn't the case before. Before you needed to be what they called a sort of professional investor, and to do that you needed 8 million of their dollars. So it's quite a big amount. So now we have that. Oh, sorry. There is one last small point that is very important that happened also very recently. So the SEC also decided to sue the two biggest exchange. So you have Coinbase and Binance. Both went. They were sued. Now they are sued by the SEC. So that's something that obviously affected a lot the market, but luckily the market recovered from that. For the moment. So if you look at the size of the market, I mean how up it went, in 2011, it drove a lot of crypto regulation, at least attempt to regulate and understand the space. It wasn't considered as very important before 2021, as I said before. But since then, all the regulators are basically racing to try to, get their, regulation out. It's not very well coordinated. And the problem in this type of, industry, as I said before, it's very much, multi-jurisdictional type of, economy. So, when you want to regulate this, if you do it, independently, then it's very likely that it will fail, because, some country will try to take advantage of, others, in that situation. So it's very important to coordinate across multiple jurisdictions to make sure that we are consistent in the way we approach that. In the US, it's a bit surprising the approach they take, because usually they're more entrepreneurial, but in this case, they're very, very anti-crypto, I would say. The approach they take, instead of giving clarity to the crypto players, is basically to go for enforcement action. I looked at the fine, the settlement, that went in the US, and what you can see basically is, for the crypto industry, it started to ramp up in 2018 until now. There was a drop in 2021. Obviously, we had COVID, so people were not at the office to issue fines. So that's probably why we had that drop. But other than that, we can see that it's the number of legal action that went against crypto is quite huge. Obviously, we can understand that there is an interest for the regulator to keep the market as is, and that's probably why also you have a lot of those action going on. So if I move on now. Sorry, what's going on? Here you are. So obviously, it's, I wouldn't blame the regulator to be afraid about crypto, because you can see on that slide that, there is a lot of money at stake. The one I have on the slide here are the top 5, crypto is basically. So it would be hackers trying to steal, crypto fund. What's interesting here is that it doesn't affect only the crypto exchange. Crypto exchange are usually, always a target. So you have here MTGOX. That was the first one that was very, very known at this time. But it also affects, network and protocol. And why is the case is because obviously, all of this is based on technology. If technology is not well, designed, then you have flows, and flows can be exploited. And that's basically what happens most of the time. Either the hacker exploit a flow in the code, or, in the infrastructure, or in the application, or it stole the keys where you hold the fund. So as I said at the beginning, if you hold the keys, you hold the fund. So the easy way to do that is to steal the master key, because, when you have a crypto exchange, usually the approach they take is that they have the master key from which all the other keys are derived. So if you take the master keys and the seeds, then obviously you can basically steal, all the funds that are managed by that exchange or that custodian, if they haven't taken some specific precaution against that. So let's jump right in terms of the risk. So obviously in 2017, the concern was about the ICOs. So it's initial coin offering. That would be the same as what you do for security. Basically, you do a public offering. And the ICOs were basically the way the crypto industry found to basically, collect funds and start their project. So that was the somehow concern before. Now I think we moved away from that, and at Axon here we basically use a framework that is the one you see there. So we look at the risk related to the asset. So obviously that's the underlying asset behind the token. So what's the risk coming with that? Then we are looking at the transaction, so all the transactional aspect, because you have people involved, and you may have also smart contract or code used for transaction. And then we look at the infrastructure in in the broader sense. So basically infrastructure would be the technology, the organization that basically, you know, are involved. So that's what we call infrastructure. So if you look at the current world, an issue with or a threat with assets would be a robber trying to steal funds or money. That would be basically a risk against your asset. Then the transaction would be, you know, the fat finger while entering the transaction. So you're basically putting the wrong, you know, beneficiary, and that's basically, you know, how your transaction, you know, failed. Or you have, and from an infrastructure perspective, that would be basically an outage. So you have an outage, so your system is not up and running. So let's dive in a little bit just to understand, you know, what was included in those different pillars. Just one thing I want to say now as a caveat, obviously, it's not meant to be a framework conversation, so I will not, you know, list all the risks for each and every section. I will just give you some examples so that at least, you know, you see how the framework works. So if we look at the first dimension, so asset, so one concern is the price. Price can go up and down. We see that all the time. And, you know, if you look at, you know, where we were in 2021 and where we are now, the crypto market basically got divided by 3. So you can see the massive dump, you know, in terms of value. And that's basically a concern that's being raised also by the regulator in the US. The SEC is basically asking in the ETF, so I'm not sure if everybody knows what ETF is. ETF is Exchange Traded Fund. That's basically a fund where you have as a you know, sort of underpinning asset is basically the Bitcoin or any other type of crypto. In that case, in US, what is booming is basically the Bitcoin ETF. Then you have the keys. So keys, you have, you know, basic, you know, issues could be, you know, you lose your key. So you lose your key, you lose the fund. You know, those get corrupted because you don't have a good backup, you know, that would be also a way to lose your fund, or somebody steal it from you. And there was an interesting article, or at least, you know, one of the key player in regards to, you know, self-custody, it's called Ledger. And basically what they build is, you know, USB stick you can use to store your fund. And the interesting thing is that they were, you know, trying to, you know, make it, you know, shiny object, some type of shiny object that everybody could wear, you know, like a jewelry. But imagine that you would wear this with you. I mean, it's very easy to, you know, steal it from you, right? You're in the, you know, in the train, somebody steal it from you. So there was a lot of complaint about, you know, that type of advertisement that Ledger did at the time. On the token side, one of the obvious one is obviously the liquidity. So, you know, if it's not liquid, then, you know, you're stuck with your token, so you can't sell it. The other one is, and we've seen that in the US a lot, when the SEC decided to sue Coinbase and Binance, we saw a lot of coin and token being delisted. So if it's delisted, means that you're not able to use the stock exchange to sell it. So that's a big problem. And obviously it will also affect the value of your asset because the price may go down because you don't have enough volume. So that's also another concern. And another one would be interoperability. So think about, you know, you have many different blockchain, how those talk to each other. If you use the wrong one and basically at some point it becomes obsolete, you're stuck with your token again. So that's...
I have a question for you. right now.
Yeah, sure.
We see some assets for crypto exchange, valuable assets. What kind of threat agents we now deal with to prevent them to steal or to negative impact to our or what kind of threat agents we deal with them in the crypto sector? For example, you mentioned about cyber attackers, right? And as we know, also there are problems with the insider in cryptocurrencies. Can you explain some threat agents more about them?
Okay, so I mean, obviously, all the threats, that you have in a digital world would apply. Like, think about a robber, a hacker, a government that want to steal your fund. It could be also, a spy, but it could be also, as you said, the insider, or even the big player out there that knows the liquidity or the size of the pool, that basically try to take advantage of the situation and dump a coin or no. A good example is stock exchange. Stock exchange basically they know exactly the liquidity. So based on that, they're able to know where, a price, the price will have a huge impact, how many people will go under, how much leverage you see on that specific token. So a leverage is a way for somebody, and by the way, I don't recommend using leverage. It's very risky. It's for professional investor. So basically a leverage would be, you're basically able to trade, up to 1 to 10 of your assets. So let's say you put 1, at stake, and then you can, multiply it by 10. So people expect to get a lot of benefit, but most of the time what happens is that they lose the 10 and they put 1, so then they need to pay back. So you have huge debt, basically. So yeah, again, like that would be the sort of, different threats you have. It's not unique to the crypto. Like, I think you would mix the one of the cyberspace and the one of the classic financial industry. That would be the sort of two, aspect I would consider. So if we move on the transaction side, so one very big topic that is it has a lot of focus at the moment is obviously anti-money laundering. The regulator is very, very much focused on this. So there is a lot of requirement getting out, about that specific aspect. One of the things we've seen also is the FATF, which is the sort of, supranational authority that it's not an authority, it's more a sort of bunch of people that basically provide guidance to regulators. They basically are looking to ban non-custodial wallet. So basically means that you would not be able to self-custody your asset, because they consider if you do that, then obviously, it's not valid for them in terms of AML control, because, you could, basically try to hide your identity. Another thing we see also is the so-called travel rules. So in Europe, you have a rule for any transaction for banks. So basically, when you transact in banking, when it goes above 3,000 euro, the bank needs to issue specific report to the regulator. For cryptocurrency, is €1. So you can see it's very they are very keen to control that industry basically. If we move on to the arrows, so that kind of obvious. Obviously, you're messing up with the receiver address. So when you send a crypto to somebody, you need to put an address. It's very long suite of characters, so it's very easy to mess up. You can also use the wrong address of the blockchain. It happened to me quite a few times. basically you're thinking that you want to send that ETH to somebody, but you're using the wrong blockchain. You're using an email, an address of an Ethereum blockchain, but then you want to send it on a Binance blockchain. It will not work. You will lose your fund, basically. So people are basically trying to, do the sort of test transaction just to make sure that it works before they send the full amount. Another one is obviously, as we are using computer, is spoofing. So obviously you have a malware on your computer and basically, change the, address of the receiver by his own address, basically. This happen all the time. It happened a lot of time when we started to see mobile app for banking. And now we have the same, obviously, for crypto asset. If we move on to the last one as processing issue, so it could be a non-confirmed transaction because you haven't put enough fees. So any transaction comes with a fee. If you don't put enough fee, it's very likely that your transaction will not be prioritized in terms of the validation. It could be network transactions. We've seen a lot with Ethereum blockchain. And that's why now we have the layer 2s, which help to, provide more capacity to Ethereum. Or it could be also, as simple as a protocol error because it's coded. And, if there is an error in the code, then obviously, it can fail and, block the entire network, basically. And the last aspect is the infrastructure. So the ecosystem, I think I touched a lot on this. So you have multiple jurisdiction, multiple regulator to face. You could also be, in trouble because you're using a major player and it goes under. We've seen that with a lot of US banks. So Signature Bank, as an example, was one that was a lot used, especially for the Signet network. And you have also cyber threats because, obviously you're operating in a virtual world. Governance is, classic corporate governance, enterprise governance, the strategy also. We've seen a lot of young people dealing with that. They don't have any clue of what they are doing, basically. And that, obviously cause a lot of issues. If we move on to operation, then it could be like you have plenty of, issues or, that could happen with operation. Like a good one is a suspended withdrawal. So you can't basically withdraw your token from a stock exchange because they have liquidity issue. We've seen that a lot in the past few months. Could be downtime. It could be malware infection on your, on the, validator nodes. So you have a lot of issue that can happen with operation itself. And the last one is a change. Obviously, we are coding. So if you, have wrong, if you don't have good development standard, then obviously you can have issues with your code. We've seen a lot of incidents related to smart contracts that are poorly developed, where hackers manage to, exploit those vulnerabilities. And as the code is public, it's very easy to find, those vulnerabilities. You can even ask ChatGPT, will tell you. So now as we get a little bit about the risk, I'd like to move on to crypto asset custody and explain why it matters, basically. So here's a basic flow of the crypto custody. So you will see on one end, you have the investor, on the other hand, you have the market. In between, you have actors that are the intermediaries that help you to access the market and, store your crypto. So the one in the middle is basically the custodian. That's the one that will keep your keys or your assets safe. Investors can be, retail, institution, whatever. And what's interesting also to note is the 3 dots you have in the middle. So from the crypto asset service provider up to the crypto exchange could be one player. And usually it is one. Like you take Binance, they do all of it. So, so they usually, combine, a different function. That's something that the regulator doesn't like, especially in the US, because they like to segregate, those functions, so they have better control. You can see here, there is a huge FOMO from the institution, and it started basically in 2022. So they basically, the institution started to, issue their custody solution. Then you had, then they, into end of 2022, they started to sell it to customer and make it available. And then, in 2023, basically it's, Europe and Asia, providing clarity on the, the crypto asset, and that basically started to create a lot of FOMO into the ETF. So a lot of players are trying to get their ETF so that they can get all the liquidity in from their investors. So you can see there is a big ramp up in terms of the crypto adoption from an institutional perspective, which is good. Obviously, it raises some concern, in terms of decentralization, because, the bigger your ETF gets, the bigger, the more asset they will get, the more asset they will get, the more control they will have, over a specific network. So if you think about Bitcoin, if you manage to have, a lot of token, then obviously you have, more control on the market, basically. So what are the options? So you have 3 options in terms of crypto custody. So the Hope wallet is basically, it's online. So that's how it works. And if it's online, obviously the security is, more of a concern. So you have less stars, but the advantage basically is that it's easy to trade because everything is ready, to go. You can just press, sell or buy, and then you have it right away. Then you have the warm wallet. It's a little bit in between of the hot and the cold. So basically you have a part that's online, it's basically a part of your keys, and then you have a software wallet that may run locally. So basically they split, the function so that, it makes it a little bit safer. So crypto, the security is, a little bit better. It's less easy to trade because you need to, basically, obviously authenticate yourself, do a little bit more, operation to trade your asset. And then you have the cold wallet, where it's, much more secure because you have full control over it. Obviously, you are the one, managing it. So you want to make sure that, you keep it safe. It's not online, it's offline, obviously. And it's good for hodlers. So I'm a hodler, so I'm keeping all my coin, not selling it. So I'm putting that in a, in a safe. I don't want to see it anymore. It's there. Maybe in 10, 20 years, I will look at it, right? So you have examples of, each and every wallet, based on the different options. An interesting, important term to understand is custodial versus non-custodial. So custodial is basically you're giving it to somebody to manage versus you're managing it yourself. Sorry, I'm going the wrong way around. So in terms of the control stack, when we think about the crypto custodian, there are many aspects to consider. So you have all the basic ones that you see in classic organization, all the IT controls. Then you have all the operational controls, so operation and policy and procedure, and you have all the governance control. What you will see in the next slide is that, some of those that failed, are not technical control, basically. In most of the case, those are those ones, right? And then you have the audit on top that basically give you assurance of all of it. The problem we see most of the time is that there is no external assurance. So no external assurance means that obviously, if everybody is corrupted, then, you're at risk, right? So external assurance is something that is being built up at the moment, and there is one player that is one standard that came up at the moment is called the CCSSA, and basically the standard provide guidance and requirement for crypto asset management and operation. So I'm basically certified on that standard, and I find it a useful tool. It's not basically the Nevada because it's being built, so there is more to come, but it's a good start to basically give some clarity in terms of what are the controls I need to consider when I'm a crypto asset service provider. So now as we have a good understanding of the risk, good understanding of the crypto asset, now let's see some of the examples. Are we safe? What's the best option? Cold wallet, hot wallet, warm wallet, what should I choose, right? The answer is none. And I would say it's not none, it's more the fact that, you have to choose, the pro and cons, and then see what best fit for you. So you have that custodian here. So that's a recent event. And what's interesting on that one, so Prime, I think they are called Prime Trust. So Prime Trust, basically, it's ridiculous it's really a ridiculous situation. So basically they lost the keys. That's what happened. So they lost the keys of their clients. So the keys where you have all the funds, they lost it. And how it happened is that there was an upgrade on the service provider. There were Fireblocks, so they were using Fireblocks. There was an upgrade, and during the upgrade, they lost the key. Too bad they could not access the asset anymore because they didn't have the key. So what happened is that it started to get noticed, and then the regulator started to shut down the operation and take control. So it's the regulator in the US, the Nevada regulator, they take control. And what they realized is that the Prime Trust didn't have any fund anymore, and they could cover only 3.5% of their client fund. That's a huge loss. So imagine most of their clients lost their fund. That's what happened because of a dumb guy that basically, lost the key. So that's more the sort of, hot wallet situation. Then you have another hot wallet situation. So this one was covered a lot in the news. So I will not talk too much about that, but basically what happens is that people started to realize that there was an issue with FTX, and especially the FTT token. They realized that FTX was using a sister company to basically, use the client fund and, use it for trading, instead of, keeping it separate and safe for the client. So that's a very bad thing. That's basically a fraud, right? And what happened is that they started to get noticed, and Binance decided to dump all their token, their FTT token. And the consequence of this was that FTX was not able to pay back because they didn't have cash on hand anymore. So as they didn't have cash, then they decided to file for bankruptcy in the US. So that's a Chapter 11 in the US. And the interesting thing is that once it happened, FTX at this point was valued around 32 billion. So that's not small. That's quite big. And they had 8 billion liabilities. So they couldn't pay basically their client back. So now it's ongoing. There is a trial ongoing. And we'll see how it goes. It's a classic sort of Madoff situation. So for those who wants to know more about Madoff, there is an interesting TV show on Netflix where you can see more about the Madoff. It's very good the way they write it, and that's exactly what happened with this situation. So the consequence of this situation is, they don't have access to their token anymore. It's all blocked. That's a problem. And it has a huge effect on the crypto market. All the market dumped because of that situation. obviously regulators started to, notice that, and then they wanted to push, to increase the requirement at this time. What is important in this situation, I think the lesson learned to me was to basically think of the self-custody as something to consider. So more, being able to manage your crypto as opposed to leave it on the stock exchange. And, if it goes under, then you lose everything, basically. Another one. So this one is a sort of...
Alex, I have a question for you. The previous slide. Slide. All we know about XTX collapse. Some custody companies claim they provide insurance for their client assets, for example.
Yeah, Gemini is an example of this. Yeah.
But when we look at it, the volume is very small. If when you compare the client's assets, so it doesn't make sense according to my mind, because when you lose lots of money, the insurance company just will help you for the small value for it. And I want you to explain about it. And another question, in the FTX case, we see they had risk management departments, audit departments, they had external audit. They had external audit services. What went wrong, and nobody could understand the problem?
Yeah, so two things. So on the insurance, I don't think it's the solution for sure. Like, you will not be able to pay back anyway. That's the same as the cyber insurance. Like, you have a cyber insurance, that's the one that, the lowest, that's the one that will get the money back, right? The other one won't get it. And that will be always a small portion of what you lose anyway. So I don't think it's a solution. And the second one is the governance aspect you mentioned here. I think in FTX, the problem was that there was no governance itself. Like, maybe they claimed they had something, but, like, if you look at the file, the chapter, the submission for the chapter 11, you will see there is a ton of issues from a corporate governance perspective. They didn't have a payroll. They didn't have, a record of all the decision. The way they took decision was they used, a system that would basically, delete the decision after a certain point. Like, it's silly if you think about it. Like a company that was, earning so much money, like, they didn't have those basic controls. So when they had to file for the bankruptcy, they couldn't even provide a list of people working for them. Like, that's just silly. So to me, the problem, like, this would have been covered with the certification I mentioned earlier, the auditor certification. Like, all of this would have been seen, because if you're an auditor and you're looking at it this way, then you're looking at governance, you're looking at procedure, and then you will figure out that there is a huge problem there. Now, the other problem is the auditor they use is that auditor is in trouble for many cases, because they're basically, I don't know, like, I wouldn't, like, obviously we need to let the regulator do their work, and the trial do its work. But I suspect what will be uncovered is that they are involved, to a certain extent, in this situation. And that's why this type of thing happens. So another thing we see is what we call the reserve, audit. So basically a reserve audit would be the same as a sort of financial audit, external audit. But what they would do is they will look at your fund. The problem is that there is no standard for that. So it's very hard to get, good assurance that, the funds are valuable and they are not, in a smart contract or whatever.
Okay, and in this type of audit, there's another gap problem, because maybe the exchange may show the auditors the value, the cryptocurrency they have at the T time. But after the audit, they have the chance to change the.
Yeah, I mean, that's what I'm saying. I mean, we need a standard for that because it's obviously, you know, it's not a permanent view. And also it raised some concern about, you know, so if you would be an hacker, you would like to know how much they have on the exchange, right? So if you make it readily available and public, then, you know, all the hacker will know. They will target Binance, you know, or they will target this one or whatever, you know, because they know how much they have, you know, available. The other problem you have also is that even though they show what they have, you're not 100% sure that that's what they control. Because, so that's why we usually do a testing transaction to see if they have control over the asset. Because one of the things they could do is they could lock all of this in a smart contract to get a loan, as an example. And then you would think that they have access to those funds, but those are locked. They need to pay the money back first before they get the fund, right? So it's very, very complex as an audit matter. And the organization that I mentioned on the, you know, the certification, they're also working on that proof of reserve kind of standards. So they're working with KPMG and others to basically try to, basically make it clear in terms of what are the due diligence you need to do and so on. So I mean, obviously, there is more to come on that. But in the meantime, you know, I mean, at least I think we should push a little bit more for more transparency and more, independent audits, so that at least we get a little bit of assurance, you know, that there is, it's being operated as it should, basically. So that one, there is that guy you see on the picture of the photo here. So that guy basically lost his laptop back in 2013 because he left it on in his office, and he had, you know, a ton of Bitcoin on it. I think it was, let me see, 8,000. So 8,000, you know, with current price would be up to 200 million. So obviously that guy is very keen to find the laptop back. And so what he's trying to do is use artificial intelligence to search on, you know, ton of, you know, rubbish, just to see if he can find, you know, his laptop back, or his hard drive, because that's where he would find the, you know, the wallet. And that shows basically, you know, why it's so important to make sure that if you store if you manage the custody yourself, make sure you have backups, you lock it, you know, your fund, you know, so that nobody can access it. So you need to consider all of this because you're responsible. It's not like when you have the money at the bank, you know, the bank will have to give it back to you. Yeah, it's your responsibility. That's a big change, right? The last case I wanted to bring up, it's another interesting one, is with Ledger. So the company I mentioned earlier. So that company provides device where you can store your, crypto. Very secure. I'm using one of those. This one actually, the one you see on the screen. And what happened to them is basically a few months ago, they in May actually, they basically came up with a proposal to with a new feature for their device, and the feature was supposed to basically allow the customer to get a backup of their keys. So if you think about it for a minute, it means that they will get the key off the secure module you have on the on the wallet and then send it out, right? So you can imagine that people are started to freak out a lot, and there was a lot on the media, on the social media, about that, because people were very concerned about that. They thought that, and that's true, like they basically broke an important rule, which is, if you use a secure device like this, you never get the key out, never. It stays on the device, it's secure, nobody accesses it, right? So from that moment, they step back now. So you're not forced to basically, do that upgrade. So I haven't done it. Obviously, I don't want that upgrade because I don't trust, a third party to manage it, my keys for me. I want to do it myself. And I guess the good lesson learned here is that obviously, it's very important to make sure that when you issue a feature, it's aligned to your corporate values. And in that case, I'm pretty sure it wasn't, because the basic promise, of the promise of that company was to secure your fund. If you send the key out, you're not sure that you can secure the fund anymore, because somebody will be able to, get those keys and steal the fund, right? So I think we went through a lot today. Hard to digest, so I have a few takeaways for you. So as it was said in the intro, I'm a huge supporter of innovation. Very important, but not at any cost, right? So we need to think of what's the battle we want to fight, and and obviously how much risk we want to take. Right. The regulation is very fluid at the moment. They are trying to race, as I said, but what we see is that they don't understand crypto very much, and that's a huge problem. And also, not only they don't understand it, but they want to keep the statu quo, right? They don't want the new entrants to basically, move all the fund out, and then for them not being able to control the crypto players anymore. So you can see, more requirement coming in from any regulator. So I talked about the travel rules from Europe earlier, but there is also a ton of enforcement action, as I said, coming from the US, and we will see more for sure. The last point I wanted to stress here is that obviously crypto technology brings a paradigm shift. So what it means basically is that people need to care about their custody. So how do you custody your fund? Before we used to have a bank. The bank was dealing was taking care about your fund. Now you need to do it yourself, or you need to choose another service provider. In that regard, I think the education is very important, because if people don't understand the risk they're taking, then they won't be able to choose the option that is the most suitable for them. And I wouldn't be surprised to see more requirement coming from the regulator in terms of education. We've seen that before when cyber started to ramp up. We've seen the Europe and Asia regulators starting to ask financial players to educate their client about the risk. And I'm sure the same will happen with the crypto, basically. With this being said, I think we are getting toward the end of this presentation. So happy to take any question there. And I'm trying to see.
I have some questions. Let me read them for you. Wait a second. Mr. Turhan had 2 questions. What areas are the focus of current crypto-related regulations requirements?
So you have different focus depending on the jurisdiction. So basically in Asia, they are more about crypto service providers. So basically trying to get those people licensed. What it means is that they will have to comply with certain rules, notably AML, market controls, and reporting for transparency and so on. In Europe, they do the same, and they have also added something about issuance of coin. So basically, let's say you want to go for an ICO, then you will have to get the regulatory approval before you go to the general public. That's a change. So if you think about the market, you have what we call the primary market, secondary market. So secondary market is the crypto exchange. Primary market is the issuer, basically issuing the the coin and selling it to a direct investor, basically.
Thank you.
Mr. I have just one other example. So in the UK, they're basically taking another approach. They are more focused on customer information. So you inform the customer, you're making him knowledgeable so that he's able to take his own decision. And they have also something about advertising. So you have some restriction when you advertise to client, basically.
Mr. Truhan has another question. Can we also assume crypto wallet as a crypto asset? He asked this question when you explain in the valuable assets, the risks against valuable assets.
Sorry, I'm not sure I got the question right.
I guess you answered in your presentation, but I read again. Can we also assume crypto wallet as a crypto asset?
Oh, no. That's not the asset itself. The wallet is not the asset. However, in the wallet, you have the keys for every asset, right? Mm-hmm. That's where you have the link. So think of a wallet like, your mobile app. That's basically the way to think about it. And then you have account 1, account 2. So you have account in USD, account in, Turkish lira, account in euro, and so on and so forth, right? And euro, Turkish lira, and so on would be a different coin, right? And each coin, they have a key, and all those keys are in your wallet.
Okay, another question related to this. Again, Mr. Truhan, can privacy regulations define crypto wallet as a privacy information?
I'm not sure. I think the privacy, so is one of the challenges we have with crypto, obviously, is that for privacy regulation or privacy regulator, they don't like it so much because it's very transparent. And that's why we have privacy coin. But then the financial regulator, they don't like privacy coin because they can't see, who, did what, basically. And that's what they're more interested about. So I think what we will see is probably more guidance and regulation about, about how to address privacy from a blockchain perspective, because that's basically the challenge we have right now.
As I see, there is no question, more question in the chat area, but I have some questions. First, you explain some gaps at there are a big problem about visibility and complexity for the blockchain technology firms, because we cannot they claim something, but there is no proof for it. There is no concrete proof for it, because the audits, after FTX, the audit firms refused to make audits, because I was director at a blockchain technology firm, risk management director at a blockchain technology firm, and we couldn't find any auditors for our company. They refused to come and make auditors, and this is a big problem. So, for example, they claim something, and I am an ordinary person, ordinary client. I give my money, my valuable assets to them, but I am not sure if what they're doing. So, is there any way to increase the assurance?
Yeah. So I think I touched on a few things throughout the presentation, but I will bring all of those together so that you will address the question. So one is, obviously, we need more regulation. And I'm pretty convinced we need more, because, not only because of the customer protection, that's what you're addressing here, but we also need for the market, practice, because we see a lot of people abusing, and taking advantage of the market, and that basically, affect everybody, and that needs to stop if we want this to succeed. So that's one angle, and we see more coming. The second one is, I think we need also more transparency with auditors that know what they are talking about. A lot of the big fours or other audit firms, they have no clue about how the entire crypto technology is working, and they don't have a strong financial background. So it makes it very hard for them to, assess the risk. So if you have an auditor that's basically skilled and, and have the right, level of expertise, then he will be able to audit that. And that will be a plus. So I would really encourage to go with those auditors so that they can, provide that sort of assurance to the general public. The one direction we see with the standard now, where it's getting with the standard, is that you can basically claim that you are level 1, 2, or 3 on a scale, and that will basically provide a certain level of assurance. And as being, audited by an auditor, that's a certification I mentioned earlier. The other thing, I guess, and that would be the third thing, is that obviously it's not financial advice, but I will really much encourage people to basically keep their fund with themselves. So if you have too much at stake, don't leave it on an exchange, because you can basically, you don't know what's going to happen, maybe another FTX or, any other things. And then, you will be at risk. So it's better to use, a device where you can store those, lock it up, so that nobody can access it, making sure it's, it's protected to, accident or, natural disaster or this type of things. And then, you'll be safe. When you want to transact, then that's where you put everything online. You do your transaction, and then everything back, on your cold wallet, basically.
And there is a big problem, I guess, again, another problem. For example, some sectors have some standards, control standards. For example, in financial, we have PCI DSS. In energy sector, there are some kinds of C2, M2 like this standards. But for crypto sector, I guess there is maybe you have, because MiCA now enforce some kinds of controls for the firms. Is there any kind of, in global perspective?
So you have the certification I mentioned earlier is willing to be the sort of standard, the de facto standard that you will have. And that's why they started with the US and Canada, because that's the one that are more advanced from that perspective. Now, what I suspect will happen is that as MiCA now, is getting enforced, then Europe will come up with their own. Usually they use the ETSI, which is basically a government, European government agency that basically provides standard to every players. Now, we have standard that exist that everybody forgot about. So think about digital signature. Why do we trust digital signature? That's exactly the same problem, exactly the same. Because if you steal the signature of somebody, then you're able to do, whatever with it, right? Same problem, same control. So they have already standard that exists. So you have in Canada, as an example, Web Trust. Web Trust in a standard that basically talks about key management. The problem with those standards is that it's very much certificate authority related. And it's not really much, so it's centralized basically, as opposed to a crypto world where everything is decentralized and managed by the people. And that's where, the standard I mentioned earlier, the one I showed on the slide, basically try to bridge that gap, to address the two. But there is a long way to go before we have something fully operational, that will address all and every issue.
Thank you. There is another question for you. Mr. Mustafa asked, is there any PAI involved in any crypto-related processes? Person identity information.
Yeah, I know PAI, thanks. It actually depends. So crypto is transparent, as I said. So basically, it tells you who sent what to who. So you can see that. You can see address, that. So it's a long chain of characters where you see the address, and then you see the receiver address, and then you see the amount. All of this is available in something called an explorer. So for any blockchain, you have an explorer. And with that explorer, you can use either the transaction ID, the address, or whatever, and then you will find every movement. Now, when you have the address, it doesn't mean that you have the name of the person, right? Because to do so, you need to have all the personal data. Personal data are either available on the wallet, because on your wallet, you created your address and then you associated it with an email address, as an example, or on the crypto exchange, because the crypto exchange will basically do all the ML controls. So they do the more advanced one, do what we call KYC. KYC is know your customer. So they will ask you your passports, your certificate of residency, and an utility bill to basically check you are who you are, you claim you are, and that's a more advanced one. So basically it means that if a regulator wants to know who transact what, basically they need to have the access to the explorer. It's public, everybody has access. And then they need to ask the exchange to give them the correspondence between the address and the people's name, right? By doing so, then they will be able to see everything, right? So obviously that's a huge privacy concern. Now, there are protocols in place that exist. You have two types of protocol. So some of them they use what they call privacy coin. So they're basically something that occults, all the details, so that you don't know who owns basically the asset. So that's one way of, going private. And that's what I suspect the digital euro will use, because obviously in small amount transaction, you don't want to see, everybody's name, right? It would be very, very concerning if we could see, that, if you see that Godkan, spent, bought a Starbucks, at Starbucks coffee, and then, now is at, I don't know, that restaurant and so on. So it will be easy to track people, right? And so I guess that's what the European Union will use for their, small amount for a customer transaction. Then there is another protocol that exists, is blend protocol. So you may have heard about Tornado. So Tornado is a smart contract that basically blends the phone and the email, within the smart contract, so that so it's very hard to find who owns what. And that's another way to basically, navigate securely. And
another question came, and this question is also helped me to ask you another question. Do you have time, Alex, for 10 minutes?
Sure. I can do a bit more if you guys have questions.
I know Chetin also make some research about blockchain technology. It's happy to see him here because he's auditor about technology. he says, "I'm sorry if I missed the point that I'll ask. Since I was able to catch you a bit late, I would like to ask for your opinion on DXX makes decentralized exchanges be thought as an instrument for mitigating some of the discussed.
Okay, I get it. Yeah, I get it. So DEX,
new risks.
Yeah, I mean, obviously DEX brings another concern is that at least it's a concern for the regulator, I would say, because they don't have control over, the smart contract. In reality, I think you'll have, so for those who don't know, a DEX is basically decentralized exchange. So instead of having everything centralized, you go through a smart contract that will basically do all the swapping. So basically you connect your wallet to that smart contract and you can do the swapping. I guess in theory, we could think that, the DEX don't have an owner. In reality, I think they will always have one because there will be money at stake. And, even if everybody claims that there will be DAO, so decentralized, organization, that will not happen tomorrow. I mean, every attempt I've seen, is not very successful. You always have a bunch of people that control everything. I went through some of those and, it didn't work out very well. So what I'm trying to say here is that, the most concern we have with DEX is that you don't have somebody to catch if something goes wrong, the protocol doesn't work and whatever. But in reality, this concern will probably not exist. Now, the problem will be how do you catch the people that manage, that specific, DEX if you have a problem? A problem could be, a cyber attack. A problem could be the protocol doesn't work. A problem could be, the people leaves with the smart contract keys and, steal all the fun with it, So I guess that's where we'll use, the classic, control we have, which is, the interpose and, all the, police, control that will help to catch those people, let's say something goes wrong. So that would be my 2 cents on that specific question.
And I have two questions related with this question. Do you think if in the currently crypto exchanges also act as custody firms, right? Most of them.
Yeah.
Do you think does it also create a problem for the clients? Because when the exchanges behave as custody, so there is a in my mind there is a problem because I cannot understand if they behave this value as it must be, it should be. When we have separate custody firm, when exchange now divided into custody and exchanges, this sounds more trustable for me.
Yeah, I understand. Obviously, you have market manipulation, as I said. So I use the example of Binance. They do that all the time. Even if they say they don't, they do it all the time. I've seen that many times. So you have you need a tracker basically where you can track the coin's price, across multiple exchange. And that's actually how FTX, made a ton of money. How they, so Sam Bankman-Fried, sorry. So the guy that was behind FTX, basically the way he became rich was to trade, in the US and then sell in, in Japan. With the difference of price between the two, then he was able to, make a lot of money. That's how he became very rich. So that issue obviously happened because you don't have segregation. Now, if you look at the ETF application that I mentioned earlier in the US, all the people that filed for spot ETF, they basically came up with that segregation. So they said Coinbase will do this, we'll use this for the pricing, and so on and so forth. So basically they break down. So you have the broker, the exchange, and the custodian. They break it down so that they can, ensure that sort of control. And that's basically what you have in the real world. So it should also happen, going forward. So, let's say you have a customer, you can't custody their fund, but you can, obviously trade, and then, somebody will custody, and, that way you manage the control. But we don't have this at the moment right now. I suspect I can definitively see the regulator asking that, because we already see the filing that are aligned to that sort of, segregation. So.
And another problem, Maria, this is a very new technology, very new concept, and the founders are generally software developers, right? The founders of crypto exchanges. And for example, 2 or 3, 4 friends came together and found an exchange, and they generally keep their keys with them. And there's a big trust problem between the people in this sector, and this is not fair for the clients, because
I agree with you. And if you look at the standard I showed you earlier, most of those projects, they will never get even the level 1 because of that exact problem, because they created the keys on an untrusted device. So obviously you can make a copy, or they are keeping the keys themselves, and they don't give it back, or they don't use multi-signature, wallet, which is also another problem. And I guess, it boils down to maturity, I guess, and and skills. You have a lot of people, they think they will make a ton of money, and then obviously they are trying to engage and develop that project and do this, and then they do shit, because they don't understand what they are doing. And that's a big problem. So the more, I guess, the market will obviously, somehow self-regulate, because the dummy people will get out. The FTX went out, like we've seen a lot of those, people. And I guess that's a good thing, right? We need to get all those unprofessional people out, so that we can start to build a trusted market, and make the, crypto industry thrive.
And this during this time, lots of people lose a big value for them. And is there any kind of control to understand if the founders act in a right way, fair way, in governance aspect? For their for example, if they keep their keys in a secure or reliable custody, can we solve this problem? For example, if someone kidnapped a founder, or the founder decide to go out the country, decide to go another country, live for himself.
Yeah. So again, like the standard I mentioned earlier, obviously cover those aspects. So basically making sure that how you manage the custody, how you ensure backups, if people leave and so on. So all of this is managed. And also you have all the things about, locking, I forgot the term. It's basically, blocking keys so that, it's not working anymore. That exists already, in certificate industry. So nothing new. And those controls will apply. Now, in terms of the, so the standard that I mentioned can help, assess those. And that's why I'm very active, there. I'm engaging in that community to push for this and getting more people engaged so that we can, bring more transparency, trust, and so on. So I'm hopeful that this will, move on. And but I guess the one thing we definitively need right now is the the regulation. Like we need that regulation, because if people think that they can do whatever they want and nobody will put them in jail, you know, like, you know, it will be the same as cyber. Remember cyber before, like, you know, anybody committing a cyber, you know, fraud could hide himself. And so now that you have huge fine, you have international cooperation. Yeah, it's very hard now to hide, right? And I guess that will be the same with the crypto world. I'm hoping it will be. But if we see what happened with cyber, I guess, you know, we can basically assume that it will be the same for crypto.
Okay, last question again from Turhan, Mr. Turhan. In cold wallet, how to sign transaction if the keys are offline stored?
Okay, so that's so remember when I saw the, sorry, oops. Oh, sorry. Here you are. So here's where you have the keys, you know, like the secure element. That's where you have the keys, right? And what will happen is that the secure element will sign. So the secure element will sign, you know, the transaction. Then it will go out of the secure element signed and then be published online, right? So that's how you do the signature. So basically the signature happen here and not outside of it, right? While if you're online, you know, it will happen basically, you know, online on the, you know, on the crypto exchange, and then they will use the node to spread, you know, the word. Here you will do it there, and then, you know, obviously you will have to send the transaction. And when you hit send, that's where, you know, the signed transaction will go out of the wallet and then being recorded on the blockchain and then being spread, you know, across. You have also models that I haven't explained there, where they do the signing on off the blockchain, right? It's sorry, off the network also, but that's the custodian, and usually they have the system is air gapped. So it means it's not connected to the network. It's working completely separately, right? No connection to internet. And then they use QR code to basically transfer the information from one system to the other. That's how they do all the signing. But in that case, it's done on the secure element. That's where, you know, the signature happens.
Thank you, Alex. You did great presentation. You answered all questions. It was a pleasure to see you, to meet with you. And I guess in the following time, we will meet again. I hope, because it was a very informative presentation. And thank you for attendees. Till this time, they were with us. And now we are closing. Do you have anything to add, say, Alex? When you
I'd like to say thank you for having me on the show. Like, I mean, I'm happy to connect with anybody. You know, if they want to ask more questions offline, like, happy to do so. Obviously, we need to educate, you know, the industry and help. You know, I'm very pro, you know, on that crypto industry, because I think it's really a, you know, a disruption from what we've seen before. I used to work in finance for many years, and I definitively see the benefit, you know, of removing all intermediaries. Like, that's a huge benefit, right? So happy to, you know, talk and engage, you know, offline if people want. And again, thanks for the engagement, the questions, and hopefully, you know, it was insightful, and, you know, you are taking something away from that webinar.
And I take some pictures, okay. And Alex, okay, see you. Thank you again. And now we're closing our webinar. Thank you, attendees. See you. We will share with you the YouTube recording. Bye.
Cheers. Bye-bye, guys. Thanks. Have a great evening.